Good evening, everybody. My name is Scott Lurie with F Street. I'm so excited about our opportunity this evening to discuss our Value-Add Multifamily One Fund, which is an assortment of multifamily value-add opportunities in the Chicagoland area. When I first got started in real estate in 2003, Value-Add Multifamily was what we cut our teeth on. We were able to acquire almost 1,500 apartments, and those were able to give us a tremendous opportunity to create tremendous value as well as great cash flow for the remainder of about 19 years. Tonight, I'm joined by Chico Patel from CKO Realty, our partner. Chico is going to be running through some of the portfolio as well as our understanding of the opportunity and how value-add multifamily should be part of your portfolio, as well as discuss the investment thesis. So thank you for being here tonight. F Street Investments is a three vertical real estate firm. We focus on three different aspects: multifamily, industrial, as well as lending in our private debt fund. I see some of our investors that are in our private debt fund are joining us tonight. Certainly want to say welcome and thank you for being here. We're really excited to have you, and thanks for considering the Value-Add Multifamily Fund One. My partner Josh Lurie is on the panel as well. And if you have any questions for us during any time, feel free to put that information in the chat. And if you just put that in the chat, we'll be able to answer your question at any time. I do want to go over a little bit about our portfolio. Our portfolio consists in the multifamily space of ground up multifamily, which you see on the left side. We just completed several years ago, 71 units in Sheboygan Falls, 134 units in Brown Deer, Wisconsin, as well as 199 units, and it just was at in Oak Creek, Wisconsin. We're about to start phase 2 in Oak Creek. We also have a lot of value-add multifamily in our portfolio. We've acquired hundreds of units in the value-add space over the last several years, and those are all stabilized assets in and around the country, from Ohio to Texas to New York to Jackson, Mississippi, back to Milwaukee, Wisconsin. And so we've got a vast knowledge of how to be successful in this space, and are super excited about sharing more about the value-add fund that we have today. GKO Realty, Chico, if you are able to just introduce yourself briefly and share a little bit about your 25 years of experience, we'd appreciate it.
Yeah, absolutely. Thanks, Scott. Chico Patel here. I run VAM, and we do everything from construction management, lease up, whether that's ground up, tenant build outs, renovations of apartment multifamily as well. Been doing it for a little over a dozen years now, and we've renovated over 1,000 apartments. Currently own and manage about 1,500 units and about 1 million square feet of retail and office.
Chico, appreciate the introduction. Current multifamily projects that are currently managed by CKO. CKO manages hundreds of apartments in the Chicagoland area. The nice part about the portfolio we're going to share with you, which is in the multifamily space surrounding, is that Chico and CKO have a tremendous grip hold already on the market in these areas. So adding and expanding to the portfolio inside of a market that we already know very well is really important to the ability to be successful in the value-add multifamily space. Partnership overview. F Street brings 20 years of experience in the value-add space. And as I mentioned, CKO has a deep experience with over 1,000 units renovated on the value-add space as well. The great part, additional to the partnership, is that we do have a built-in management firm with CKO's vast knowledge and experience in the space. They will be managing the assets for us, and we're super excited about that partnership. We'll talk a little bit more about that in a minute. So VAM Fund One, why invest? It's a hard concept for many people to get their arms around, the ability to buy something that's worth way less than it is in the future today. People struggle to understand what that looks like. And so many people, including some of our lenders, always ask, how can you buy something for X and it's really worth X times Y? And I always say, well, there's always an opportunity when a seller, distressed in nature by either financial constraints or by value constraints or by debt constraints, needs to do something, and their motivation is different than what the motivation is that might be at a market rate. And so when you find value add multifamily, we're able to buy a distressed asset at a lower value, and then make improvements to it. And generally, our improvements are considered in two fashions. We either improve the physical asset through improvements of capital expenditures, windows, roofs, flooring, kitchen cabinets, etc., or we improve the tenancy and then improve the NOI, which is the ultimate driver in how we create the value. So our goal is to create a value-add multifamily fund. We see tremendous opportunity. Our opportunity is only starting in the Chicagoland area with about 500 units of multifamily that we're able to control and close on in the immediate future. Once we get past these 500 units, we see a greater Midwest reach for the opportunities to be able to acquire distressed assets in the space of multifamily, and create the opportunity, which is drive rents and then ultimately drive NOI by managing expenses and increasing top line revenue. So the question is, why invest, right? Why invest in such a category? Well, there's a lot of compelling reasons to invest in such a investment thesis. I think first and foremost, it's all about the jockeys. I think you've got two really great jockeys within F Street, Shy and CKO, as partners to create, implement, and be successful at the end of the day in terms of what our business plan is. We're going to buy a distressed asset. We're going to completely improve it. We're going to re-tenant it. We're going to then refinance it. And that thesis is really easy for someone to understand along the total spectrum. Demand for multifamily continues. The last article I read showed that we had about 4 million 4 million dwelling units of shortage in the United States. And no matter where you are in the urban markets that are attractive to many, many different businesses and subsectors, the demand for housing remains. And there is no shortage of demand for housing in the Chicagoland markets. And so we see demand remaining incredibly high. Location, despite what we all read in the newspaper, I just was in Chicago. Chicago is an unbelievably vibrant town, community, city. It's got tons of economic drive to it. And like every community, it has its problems, just like the one I'm standing in Milwaukee and the one you might be sitting in somewhere. However, once we get past the flashy news articles, there's the core economics of these cities, and specifically Chicago, remains strong and thriving. And then obviously the multifamily space is really important. If you don't have multifamily in your portfolio, or you do have some multifamily in your portfolio, multifamily is a true and tried tested asset class that must be represented in your portfolio, in your alternative investment portfolio. And this is a great opportunity to buy low and sell high. That is a great opportunity for you to consider. We obviously think, when we think return, some people look at 5, 7, 10-year horizons. With value add, it presents a really unique investment thesis where we can do all of that in a short, abridged version. We can buy, stabilize, and refinance all within 24 to 48 months versus other markets that if you were building ground up multifamily where you have to build it for 18 to 24 months, stabilize it for 12, look to refinance after trailing 12 months, and then you're dealing with a 5-year investment thesis. We already have the structure and the infrastructure in place. So we simply will be able to expedite the business plan, which is the ultimate play for us, is to refinance at some point in the immediate future. And once we refinance in the immediate future, we'll be able to return capital to investors. And then obviously the great team. We have a leadership team with Shy, Chico, Josh, and myself that I think are some of the best in the business. And we certainly is a compelling reason to invest with us. So we talked about the investment thesis. We're going to talk about it briefly again. We're making strategic acquisitions. We are out in the marketplace making acquisitions on distressed assets. We look at distressed assets in two categories: distressed by its physical characteristics or distressed financially. A physically distressed asset might have some of or different characteristics than a financially distressed asset. We look at all of the categories where we can buy way below market at a per unit cost that is ultimately hundreds, if not a couple $100,000 below replacement cost per unit. But in addition to that, it's also way below market value in terms of where units like we're acquiring as a comparable set are trading for in the marketplace. The second piece of it is we then take the proposition of the distressed asset, We then fix it up. So we will make improvements to the property, which we're going to discuss in a little bit. Those improvements are sometimes cosmetic, some mechanical, some structural by nature of roofs and windows. But we make material replacements, and then we drive NOI, which is by getting the rents to market rent. And once we're at market rent, we're managing expenses. And Chico and his team do a phenomenal job managing expenses, and each expense on a cap rate basis is material to our ultimate value. So we do have an unfunded approach here. We are segmenting and creating tranches of multifamily. You can be part of one tranche and not part of another. Some people like to have the unilateral approach that I want to have a feeling on the investment and I'm going to either be in or out of one of them. That's completely up to you at your discretion. I will tell you that 99% of the investors that are in our portfolio defer always back to myself or Josh or Chico or Shai as to, hey, what should I invest in? But if you have if you had some personal reason you don't want to invest in Harper, but want to invest in a different property, you certainly would have that ability. So multifamily asset category, for those of you that are already involved in it, you probably already understand what a lot of this is. For those of you that are not involved, it's income stability, right? It's a true tried steady eddy of the investment community. It's right down the middle. We do see rent growth. We've seen a tremendous amount of run up in rent growth over the probably last 5 to 7 years. We'll probably see some stabilization or some dip in some of the higher end apartments. These are going to be Class B apartments. And in that subcategory, those apartments generally have seen inflationary growth in rents, but we don't see any volatility downward that you might see in some other potential multifamily, although that has not even come to fruition yet today in the markets we're in. Multifamily is obviously recession resilient. Everyone needs a place to live, and we're still seeing tremendous demand with occupancies in the high 90% across our entire portfolio. And we see that as a continued forward-looking guidance. Interest rate, let's be honest here. We've seen a massive run-up in interest rates. That's creating the opportunity for some of the financially distressed assets we're seeing and we'll continue to see in the market. We're seeing interest rates that are rising and operators that are not paying attention to those rising interest rates. And as a result of those interest rates rising, they're not able to either A, meet their covenants or able to refinance their debt, or they're way underwater in terms of their debt, which is turning into the opportunity for us and the partnership with CKO. So we are mindful of the interest rates. We did anticipate seeing 5 interest rate reductions here in 2024. Our outlook at this point is that we probably will not see any in 2024 and might see some tapering in 2025. I just saw a report that said, hey, we might see one in June. I'm not optimistic at all, but we'll see what happens. The jury's out. We're not here to look in the crystal ball other than to say we're very mindful of interest rates, and multifamily has remained consistent and cap rates have remained competitive in the space. And then obviously the continuous performance of the housing component. Housing is a vital necessary needs in our society and will continue to be part of what we see as a great investment thesis. We see no true signs of housing demand slowing down. So we talked a little bit about our business plan. I'm going to run through it one more time just so everyone can kind of get a big idea of it. It's probably hard for some people who have never either seen this before or ever recognized what could happen. There's an opportunity to buy something at below market and sell it for us, drive it to what is market rent and rates of value, and then we'll refinance it. That thesis does happen. So we're buying distressed assets. We classify those in 2 categories: distressed financially or distressed by the physical structure. We're repositioning the asset. We're going to make some improvements, and then we're going to reposition that asset for what is the ultimate goal is in 36 to 48 months, refinance the portfolio and get everyone their money back. So we're going to create a tremendous amount of equity. And from that equity spread, we're going to create new debt. We're going to put a new debt structure on it. And then we're going to refinance and repay our investors. The upgrade, obviously upgrade to enhance the asset, to increase the tenant Appeal, yes, curb appeal is important. Everyone likes to live in a great environment, and we create those great environments. And then obviously inject new energy and improvements in emphasizing superior property management. Chico does a phenomenal job managing assets. He's going to talk briefly about how he manages the assets in a minute, and we're going to run through the portfolio of management. But managing these assets is so important, and having a partner who's vested alongside us and you with not only energy, time and energy, but money is so critically important to what we're doing. And we're really grateful that we've got Chico as part of the deal. Management, obviously having Chico involved, as I said, he's our manager. He's got thousands of units of experience. He's coming into these units with his eyes wide open. He's already built phenomenal budgets of what we're going to be replacing and improving. And his idea of the target rents are conservative. So what does that mean? Well, we're not shooting ourselves in the foot, but we're also not giving you a glass that's way half full or overflowing. We're telling you that here's what we believe the rents will be, and hopefully we can come in above, but we're really confident in our numbers, and those numbers are what are going to tell the picture. Tenancy is really important. If you get one bad apple, they say one bad apple can ruin the world. In a multifamily building, that is so true. And obviously the screening and improvement process is critical. We talked briefly about the refinance. This is the aha moment for everybody. The aha moment is the refinance. When we get to the point where we can drive enough value and drive enough NOI, which ultimately will sit behind a cap rate to get us the values we're creating, we've got lenders ready to go that are going to be refinancing these assets and providing us with liquidity that's going to return your investment. So I use the reference all the time of money tree, but this right here is the biggest opportunity to plant that tree. Right now, you're going to plant it in the next 30 days. You're going to say, I'm going to commit X amount of dollars to the VAM Fund 1. Once you plant that seed in 24 to 36 to 48 months, so 24 is the earliest and 48 is the latest, that we should have all of your investment back to you. But that doesn't mean you stop getting payment. That doesn't mean you stop getting checks. That doesn't mean your equity goes away. Once you invest, you are always an investor of the opportunity. You never, even though you get your money back, you always are an investor. And our goal is to get you paid back as fast as possible. And that to me is the aha moment where the money tree really does exist, because once you plant that tree, you can have that tree continue to shake for you and continue to deliver you returns with $0 invested. There's no other investment out there in the world like real estate that gives you that opportunity. And value-add multifamily is probably the only subcategory, other than the anomalies in the space, that give you the fastest chance, which is only 24 to 36 months to 48 months, that gives you the chance to get that money back. It's that unique. And then obviously as the exit strategy, we'll continue to refinance. We're going to work hard to refinance the assets. But after that, there will be a point in time when we also sell the asset. And when we sell the asset, you'll get your last kick at the money tree before you chop it down. And the chopping down experience will give you a nice windfall of additional spread of cash in return. So how do we increase value? Value is increased, obviously, in the multifamily space in several ways. We're going to obviously increase the rental income. We're going to enhance the tenant appeal. But here's what we're going to do. We're also going to improve the tenant retention, and then we're obviously going to stabilize the revenue stream, right? We want to make sure that we have tenants that are in the property that are paying rent every month, that are staying for a minimum of 13 to 16 months. The longer we can get them to stay, the less turnover we have, the more stable our revenue stream is, the better off the building is, the better the value is proposition of the property is. And we do all of that through Chico. Through CKO management is very, very involved in making sure that all of this happens at one time. Because the tenant he picks at the beginning is the tenant that's going to stay, that's going to stabilize our revenue, that's going to make us stronger. And so that is a really important piece of it. And if you didn't have the management, if you don't have the management tied into what we're doing, you'll struggle to execute on the global plan. Question is, Will there be any distributions in the first 24 months? So we are paying a preferred return of 7% on the preferred return. That money, once cash flow starts, will be paid. Depending on the assets, the answer is yes, we will have distributable dollars. The challenge becomes is that one of the buildings, which is my favorite building, but one of the buildings has to actually be completely vacated because there's enough improvements in the mechanical systems and the infrastructure that we have to actually start with zero, and so that will take a longer period of time to create the value. But that one, to me, has the best value proposition on a going forward basis. So yes, expect distributions. Don't expect them in the first 12 months, but you can expect them. But think about your money as like in this fashion. You're putting in money, let's call it 100 grand. You're earning, which we're going to talk about, 7%. So you're earning $7,000 on your money that first year. You might not get it in your hand. You might not actually have it, but it's part of what we owe you as an obligation to you. And so that obligation is you're earning money on your money. So you're earning above market rate on your money starting day one. And as soon as we have the cash flow to pay you back, I'm trying to reduce this money. I want to take your $100,000 and make it zero so that we can stop paying the preferred return and then we can start sharing the sponsors can start sharing in the cash flow. We're going to talk, what was the second question? Yep. So someone asked, what is the expected value of the $100,000 post repayment? And we'll get to that at in a few seconds here. So we talk about deal structure. Deal structure is really important. So let's talk through this. This kind of walks through exactly what I was just saying. We have two classes of investors. You, meaning the investor, is a Class A investor. Us, meaning the sponsors, are a Class B investor. So this is pretty similar and pretty traditional by way of a syndication. We have syndicated and broke out the categories into two different classes. The Class A has basically all of the rights, post management and managerial obligations you're providing us to operate and make this successful. So as a Class A investor, you receive a 7% preferred return. You get 100% of the free cash flow until your money is repaid. So our job as B is to get your money repaid to you as fast as possible, because we are going to work our butts off, and we're so excited to do so. And we're going to do that incredibly hard and in a long period of time, meaning 12 months to 24 months, to get you repaid so that we can start sharing in the cash flow. And then once you have 100% of your money, now you have $0 invested, you continue to receive 40% of the cash flow, as well as 40% of the proceeds from the sale when that happens, or any future refinances. We then share in the 60% of the cash flow on a going forward basis once we've paid you back all of your money and your 7% preferred return. Are there any questions? No, good. Excuse me. So asset retention. Our intention is to buy and hold the assets in the VAM fund. A lot of people have classified real estate and put this whimsical IRR method on it, and we'll talk about that in a minute. We're going to address it right here. We want to be investors forever in these funds, so we want to own these into perpetuity. But I could only own these into perpetuity if you, the investor, A, make the investment, and B, get all of your money back in the 24 to 48 month period, plus your preferred return. So think about the proposition. You're a high net worth individual. You've worked your butt off. Whatever you've done, you have qualified under the SEC guidelines that you either are worth $1 million, or each year you have earned $200,000, or you and a spouse have earned a family income of $300,000. The last thing you want me to do for you is give you a tax problem. So if I sell the asset, I'm going to give you a tax problem. If I refinance the asset, I'm not giving you a tax problem. Which would you prefer? No tax problem, continued cash flow, or let me boast a high IRR and give you a tax problem. Now, if you add insult to injury, if I forward depreciate through a cost segregation study, which we're planning on doing, to give you depreciation in an advanced rate today, right away, to make your investment even worth more, if I'm able to do that, which we are, and then in 7 years, I am forced to sell the asset, you're going to get a massive tax problem because you have to recapture all of the depreciation that we've already provided you. So think about this. This is an investment where you're going to create value. You're going to create lifelong cash flow. You're going to be part of Value-Add Multifamily One. You're going to make an investment today. You should have all of it back by 48 months from now, and you will continue for the life of the fund, which is hopefully into perpetuity. You will be continuing to get cash flow. You'll wake up and you'll say, oh, that my investment in Value-Add Multifamily One paid me again this month, paid me again next month. And we'll be doing that. And you'll probably get tired of saying that after, I don't know, 10, 15 years. But we'll continue to send the checks. Our goal and asset retention is to rapidly return capital, right? Think about this. We want to return this capital to you so bad because we are going to work so hard and we get nothing, zero, until you get your 7% preferred return and 100% of your capital repaid. And we talk about money trees, which I talked about a little earlier. This is my favorite expression because everyone always asks me, and I always ask my parents, where's the money tree, mom and dad? How do you get all this money? How do you get money to buy dinner and groceries? And my dad would say, there's a money tree out back. Little did I know there was no money tree, but I thought it was a clever answer. And so I now actually realize that I can plant real money trees. I can plant a money tree by you making an investment, us buying distressed assets, us paying you all your money back, plus your preferred return. And when all of that's done, that tree continues to pay you. So imagine having 10 of those over the period of the next 7 years. In 10 years, you're going to have a lot of money trees. That's pretty cool. Yes. Yes, the question is the 7% preferred return an annualized rate? The answer is yes. This is a 7% preferred return on your investment per year. So that's an annual return on your outstanding balance. So if we refinance a property in month 10 or month 12 and pay you back 50% of your investment, you've now have 50,000 back. We've now paid you your investment of $7,000, 57,000. And now we have 50,000 out there earning only 7% on the 50,000 because you've already received the 50,000 plus the 7,000. The minimum investment, we're at $50,000 for the minimum investment. I believe we're at 50,000. We have a $50,000 minimum investment for the fund. We originally came into the fund with a higher investment threshold, and truthfully, I hope everyone invests as much as they can in this opportunity because these are those unique opportunities that give you the ability to repay the investment in 24 to 48 months. I was able to build a $300 million real estate portfolio, and I was able to repay all of my investors. At the end of that portfolio, I had 100% leverage and cash flowing like crazy, and my investors had every one of their dollars back, and they were getting checks every month and continued until I sold that portfolio. It's an unbelievable opportunity. Return of capital and preferred return. The pref, as we discussed, it's a 7% preferred return. In the event that we return capital, capital is returned through excessive cash flow, refinance, or liquidity. So how do we return capital? We are going to refinance the properties. We are going to execute on our business plan. We're going to start that with buying distressed assets at a low value. We make a lot of our money at the buy, right? We do a lot of our heavy lifting right when we acquire the properties. We're buying these at a distressed value that are way below market and certainly below replacement costs. Then we're going to make those improvements. And then once we do that, the aha moment, the big moment, the moment that Shai and Chico and Scott and Josh all high-five ourselves and says we did it, is when we just signed our loan documents for the refinance and we can return capital to you. And we hope to do that in 24 to 48 months. And then individual properties. With 21 properties in the portfolio, we can refinance any one of them at any time. If one of the 21 is performing better, we might refinance that one in month 6. We don't know. We don't want to set the benchmark, but we're setting it at 24 to 48 months, and we think we're going to be able to reach that target. But with 21 properties in the portfolio, any property can be refinanced as a single asset at any time. We like to disclose our fees. I think it's important to do so. These are our fees. We take an acquisition fee. This is the only fee we earn up front. We do take a 1% asset management fee. CKO, as the managers, we have hired CKO to be the manager. They're earning a market rate fee of 6%. When we dispose or refinance, these are half points. These are basically covering a lot of friction that goes along with the mechanics of making things happen. These are incredibly low fees, and these fees are completely within market, but we do want to disclose them to you so you understand them. And if there's any questions about them, I'd like to answer them. Okay. We're going to run through some of the highlights. We're going to keep it high level. I'm really excited to introduce you to Chico Patel, who is a phenomenal partner. I'm going to have him come online. He's in the panel right now. If you have any questions about Chico's experience or our management partner, put them question in the chat. We'll certainly get it to him right now. Chico, thanks for being here tonight. Let's run through some of the highlights of the investment.
Sure, absolutely. So as you had mentioned, total raise is about $15 million. Given where the properties are in terms of conditions and all that, we're buying them for about $78,000 a unit. Some properties are in better condition than others. Some are mismanaged, some are operationally challenged, some have lender issues where the current borrower is either in default or what have you. And some of them are really heavy lifts. Scott, as you mentioned, the property in Hyde Park where we're going to have to fully strip the building down and start all over with new mechanicals, elevator, rebuild all the units, and so on and so forth. And our stabilized value is about $135,000 a unit. So we're creating about $30,000 a unit in value, and a conservative number, which we feel pretty comfortable about in terms of stabilized cap rates that we're looking at, talking to appraisers of larger companies and seeing what they're seeing in the marketplace. What else can I add?
Nope. Am I back on? Yeah. So Chico, let's talk briefly. We've got a post renovation stabilization of 135,000 units. We're buying a portfolio with 21 units in it, 21 buildings total of the aggregate. We talked a little bit about you mentioned Hyde Park. Can you kind of just maybe run through what Hyde Park, you said one that needs a complete remodel. So what's our business plan there? We're gonna remove the tenants. We're gonna then do what? Maybe high level, give us a little.
We've already started architectural blueprints and engineering studies for submission to the city of Chicago. The elevator needs to get replaced. It's a 5-story building, or 6-story building located in downtown Hyde Park, which is home to the University of Chicago. And then there's 2 retail tenants that are severely under market rate rents. There's a new hotel going up across the street, and this is where we lean on Sumishai's retail experience to re-tenant that with market rate tenants that are going to pay top dollar on a net basis, to allow some pass-throughs of property taxes, CAM, insurance expenses, and things of that nature. As far as the apartments, we're going to modernize all of them. So all new electric, plumbing, new windows, as I said, new elevator. We're going to add some common area amenities, a bike area, a small lounge, just because there is a student population there that you have to cater to. What we like about this is that our blended rents around $1,350 a month, which is very attainable in terms of, and very approachable for a lot of the demographic, whether they live in Hyde Park or are potentially looking to migrate to Hyde Park versus a $3,000-$4,000 a month rental. So.
Great.
once we're done with the construction, it's about a 18-month timeline. We'll have it refinanced out of the existing construction loan that we're taking on. And we should see, I think that one's about a 5-year payback period for the Hyde Park, but 18 to 24 months of that is just construction and refinance.
Great. And Chico, we're going to go through each. We're going to briefly go through each property in a nutshell. But to briefly discuss the sample investment, someone makes an investment of $250,000. You're committed is by June 30th to secure equity and start accruing the 7% preferred return. We're focused on June 30th. We'd love to get everyone invested and committed sooner. If you're ready to commit tonight or you want to ask any other questions, please do so. Our commitment dates for June 30th. A renovation should start immediately, and rental income and return should start in Q3, Q4 of 2025. So that's a little over a month, a little over a year. But to answer someone's previous question, cash flow should commence sometime in 12 to 18 months is our goal. We intend to refinance at the end of 2026. We're going to complete all the projects. We're going to make all the updates. We're going to do all of this work. And then at the end of 2026, we are scheduled. Our business plan is to refinance the assets. And once we refinance the assets, we are going to return that capital to you. Annual income post-capital return expected to be $9,000 quarterly. $9,000 yearly from a $250,000 investment once you have all your money back and all your preferred return. So the assets, we're going to run through these a little quickly just to be mindful of everyone's time. It's 5:45 tonight. Chico, you mind taking this down for us a little quickly, starting with Jackson Highlands and the 237 units?
Yeah, absolutely. So the Jackson Highlands properties, which are comprised of 237 units, we currently own and operate within that submarket. We manage and own about 500 units already. Some of these buildings we've already closed on and have started renovations at 6849 South Clyde and 6811 South Paxton. That's a market that we know really well. We've started some lease up where we're hitting our rents or achieving higher than expected rents on the 2 properties I just mentioned that we've already started work on. Bronzeville is about 2 miles north of Jackson Highlands. It's by IT.
Chico.
Yes.
Chico, I'm going to interrupt you for 2 minutes because I thought this was the deal slide, but we have a detailed slide on each of them. So bear with me for 1 second because we're going to start with Harper actually on the backward side of this flip. So all of the properties are located in the Chicagoland area. Chicagoland is still a thriving economic center, and there's great things happening here. So let's talk briefly about Harper, as this is obviously one of the ones that needs the largest amount of renovations. Maybe we could take down Harper for us.
Absolutely. So as I had mentioned, we're targeting 1,300 a month blended on rents. Most of the units are studios, as you'll see. We're buying it for about half of the stabilized value. We're adding about $3 million in just over $3 million in CapEx. Our total budget's about $4 million with soft costs and architectural and interest reserve. And we see this building stabilizing around $12.5 million to not only take out our construction loan, but also take out a good portion of the equity. I think it's over 75% of the equity will be returned upon stabilization of the property and refinance.
Great. And for those people that might not know Hyde Park, I mean, how far is this from the university? Obviously, proximity to the University of Chicago is very close. Great, thriving market.
Sorry, Scott. I was saying the property is about 3 blocks from the university. So,
okay, perfect. Yeah, here's a couple pictures of the current asset right now. The retail first floor is obviously where we have an opportunity for some significant lift, sharing some operating expenses, etc. Let's break it down quickly from just high level of what we plan on doing here. Yeah, economically, Chico.
Yeah, majority of the equity will go towards the renovation and construction. Acquisitions just over $6.1 million. The reserves are for a full 18 months of interest reserve, to allow for lease up. We've got, of that $3.1 million, we've got some money allocated, about 120 grand for tenant improvement allowances for the 2 retail tenants that we'll be replacing. And we feel good about where we're landing in terms of an exit cap rate as well on the right-hand column.
Yeah, and one other thing just to mention, obviously the DSCR coverage is really important to us when we look at the refinance opportunity. That's a huge covenant that people are focused on, and was certainly post stabilization feel really good about where we'll be to be able to execute on this refinance. Chico, let's run through Ridgeland portfolio. The Ridgeland portfolio is obviously maybe you could start with just obviously let's run through all 3 buildings maybe at once.
Absolutely. So it's comprised of 3 buildings that make up 42 units. It's called the Ridgeland portfolio. 2 of the 3 buildings are on the same street. One's a block over. So it's a nice economies of scale within a very short distance of each other. The nice portion of this deal is that we've been able to get rid of interest rate risk by taking on the existing loan at 4.5%. And so this will allow us to finish the miscellaneous renovations, get the rents up to market rate. The current owner is an out-of-state investor, and so they're not in Chicago to be able to maximize the value. They rely on a third party here versus being able to micromanage a little bit more. Once we're stabilized, we're going to be able to get all of the equity out. I think that one's about 3.5-year hold before we get all the equity out. And we underwrote that at about a 6% exit in terms of an interest rate. So we're not getting too aggressive on what true interest rates will look like.
Sure, and this is one of those that has a not as much of a physical distress component to it, but $250,000 of repairs, assumable debt at 4.5%, allowing us to favorably navigate the waters to get to that exit refinance, which is so critical to what we're doing. If you look at all of the assumptions here on the financial component of what we're doing, we really have been so conservative in a healthy way to provide a realistic opportunity for you, the investor, to get a clear sight into the way we're thinking through the puzzle, as well as to understand how our refinance will come together to be able to repay your equity investment. Jackson Highlands.
Yep, absolutely. So this was the first one we were looking at. We currently own and operate about 500 units within that submarket, where this was a nice economies of scale for all parties involved. We're able to share some of the cost savings to F Street as well as ourselves, just because our team is already there. The rents on the right side, Scott, as I said, we've already started work on two of the buildings, which is 6849 and 6811. At the top right column, we're getting a little bit above $1,000 a month on the 1 beds. I know we've been beating our 2 beds by about $50 a month already. So we feel very comfortable about where the rents are. We're doing pretty heavy lifts on these: new kitchens, new bathrooms, new plumbing behind the walls, making sure all the electric panels are updated to avoid any shortages and things of that nature, landscaping, and we feel very comfortable about this portfolio. It's an exciting one. Stabilized value is going to be around $22 million, so there's a nice spread there.
And just running through your rehab budget, this one obviously has about $3 million of renovations. Are most of these, can you talk a little bit about that budget for a minute?
Yeah, so some of the buildings are in good shape. They're poorly managed. Others need a lot more work. And so some units are going to be full renovations where we're spending $30,000, $35,000 a unit. Others are, quote, light turns, where we just need to remove the existing tenant, clean up the unit, repaint it, miscellaneous repairs, and then re-tenant it at market rate rents to maximize collections and operations.
Great. And obviously, once again, we're at a 1.63 on the DSCR, the debt coverage, with a cap rate obviously showing at a healthy ability for us to execute on a business plan there. And then Brownsville collection. Let's run through this one.
Sure. So on this one, there is a cumulative assumable debt component of about 4.64% across the 400 or the 149 units, pardon me. The nice part of this is Bronzeville is a market that has seen tremendous growth in the last 7 years. A lot of single family homes, some of them are starting to trickle close to $1 million in sales price once they're built. And the other aspect of this is a current owner. What they did is bought condo quality units back in 2008 after the housing crisis and started deconverting the buildings into apartment buildings versus condos. And so all the units in the Bronzeville portion have in-unit laundry, individual hot water tanks, individual furnaces, and AC. And so we're able to truly have, quote, condo quality units at a scale they're all within 7-8 blocks of each other. But the assumable debt piece at 4.6 is really nice because the cash flow is really strong based on that.
Yeah, and Chico, obviously, based on its being conversion from 2008 or from a housing crisis, you know, for 140 units, you only have $1 million of renovation budget. Can you kind of walk us through that renovation budget?
Sure. So for 104 of the 149 units in this particular portfolio, most of those have already had brand new electric services in the last 12 years, brand new roofs, brand new windows, individual furnaces, washer dryers. So a lot of the renovation construction budget is to remove existing tenants that are probably under rented, allow for some CapEx that will come up in terms of just furnaces and things of that nature, because they will come to the end of their useful life in the next few years. And just give it a facelift in terms of the units, because they themselves have the granite or the quartz counters already and things of that nature. So we're just maximizing operations.
Excellent. So obviously, Chico, let's talk a little bit about your renovation strategy on the global level. You've obviously gone through all the properties. We've obviously walked through everything. We've obviously created a detailed renovation budget that you've outlined. Can you maybe just walk through kind of very high level? I would just need to be mindful of timing here.
Sure.
I think it's important that people understand, and we at least share with people, how did you get to these budgets? Obviously, you renovated thousands of units. So when you walk in a unit, you kind of understand it's going to be X. Kind of walk through that briefly, as well as your expert management that you already have lined up and experience there.
Sure. We tend to standardize most of the properties that we own with a similar model in terms of paint, lighting, flooring, cabinets, quartz countertops, and all that. So I have a very good idea of where we're going to be. We always bring our contractors with us to come up with the budget. And so from that aspect, it's a tried and true method for us locally in Chicago, especially in these submarkets.
All right. So just briefly, to be mindful of time, for the Harper, this is the highest budget we have in terms of unit per count. We've got $3 million going in. Here's the outline of budget, and then the per cost unit, which equals about $20,000. Jackson Highlands, we've got $16,000 per unit going in at $2 million, $2.4 million of total budget. If you look at Ridgeland, we're at very low with only $1,600 of renovations that have to go in, mostly exterior repairs. And then on the Brownsville, once again, buying units that were already converted, then deconverted, leaves us with about a $6,000 budget, $6,800 budget per unit. This is a very important piece of the puzzle, making the units better through improvement by physical improvement is also one of the most important value opportunities for us, which allows us to drive the rents. Investment details. Let's talk structure highlights timeline. We'll flip through this quickly, but we're raising $15.3 million. Minimum investment's $50,000. We're looking for commitment at some point in the near future, with capital being called probably at the end of June. Timeline, important to see, closing on the end of June in round one, Property renovations are going to commence immediately. We're going to look to lease up during that 24-month period, refinance capital with a goal of providing 100% of the investor capital back in 24 to 48 months. What could be better? I don't think anything. We're going to continue to manage the portfolio, and we're going to continue to distribute you cash flow after you made your investment. How do you get involved? We have an online investor portal. Our team at F Street has worked incredibly hard to create a user-friendly portal, fstreet.com. The Value-Add Multifamily Fund 1, VAM 1, is available for subscription on our website today. Click on it. It costs nothing. Sign up. It costs nothing. Learn more about it. It still costs nothing. Once you get involved and you want to ready to make the investment, we're ready to have you involved. It's an easy subscription process. You can view the documents, review the documents, then you will be applying your digital signature and then receiving our wire instructions to submit your capital to the investment. Earn your badge. We are a 506C. We are investing under the SEC guidelines under the 506C. We filed a Form D with our government under the Securities and Exchange Commission under the 506C, which is general solicitation. As a result of general solicitation, every one of our investors must be third-party accredited. The great part is when you log into fstreet.com and go onto your online portal, the online accreditation is free and it is self-integrated into the portal. So you will have to upload a few documents to our third party, which is Parallel Markets. They will review those and they will return to you your accreditation. It takes, from the people that have all their information together, it takes about 10 minutes. It's super fast, it's super easy, and it's free. Once you get that, you earn your badge. Once you earn your badge, that badge is valid for 5 years. Then you can review and view all of our investment opportunities. So let's invest together. I'm so grateful for everyone to be here this evening. I want to thank our partner, Shai, Chico, my business partner, Josh, who's in the room next to me, as well as our entire F Street team. I want to thank you for joining us on this webinar tonight. If you or friends or family were not able to join us, but have someone who wants to see it, we will be sending out this recording. I want to thank Chico for the information and participating on the panel today. And I also would like to open up, are there any last questions anyone has for us this evening that we could answer for you? If you're too shy to ask them behind the keyboard, we're absolutely happy to jump on a call with you at any time. But if there's any questions, I'd love to answer them. Yeah, so the question becomes is what are we doing in a refinance in 3 years if interest rates are still at 8.5%? Well, we'll still refinance. It would reduce our ability on proceeds to get you 100% of your money back in that time frame. So we still feel confident with the business plan, but the business plan, the tweak would be coming is that we wouldn't be able to execute on 100% of the return of capital. The remaining capital would have to come from the free cash flow of the properties. And now, in my opinion, I don't see us staying in the high interest rate environment that we're in today for the next 3 years. I do see us struggling as we try to control, our government tries to control inflation. I do see us struggling to get interest rate reductions in 2024. I do see our economy's demand as well as an interest rate environment that will settle in the 5 to 6% range as our going forward rate at some point in the next 24 months. But what do I know? I probably could have said that 24 months ago, and then I'd still only have 12 months to get there. So I don't have that crystal ball. We're going to continue to drive rents. And if interest rates remain high, the cost of living is going to go higher and rents will continue to rise. Yep. And a good comment from Josh. Thank you for that. We also have projections to refinance with a government agency, Fannie, Freddie, or HUD. Those interest rates today are in the mid 5s to low 6%. So the federal government has loan programs available to us today that are not at the interest rates you're seeing, which are the 30-year long-term mortgages. We are financing in the high 5s to low 6s right now with Fannie, Freddie, or HUD. We just closed on a deal in the low 6s. So the business plan will come together in terms of if we go agency, which is Fannie, Freddie, or HUD, or if we choose to refinance with local lenders, so long as rates are competitive. We'll see what the future brings. We still remain confident in the business plan, but we see that happening and we see us executing flawlessly through that process. So the question is, when does the 7% pref start? That's when we would call your money in 2 phases. One is a deposit of 10%. When the remaining capital is in, when all of your money is invested, your 7% preferred return commences. Someone also referenced the $9,000 is low. And the answer is that's post everything. So you've made your investment, you've returned all your capital, you returned all your preference. That doesn't include any refinance. That doesn't include any additional opportunity or upside of what we're projecting. So we're being conservative here because we don't want to say it's low or high. We have room to improve on that, but we want to set the expectation of once you have 100% of your money back and received all your preferred return and own your equity, that's what your projected monthly cash flow will be today based on our projections. That number most likely should go up, and that doesn't include our success in any of the refinance trade. If we were able to successfully refinance everybody and get another $1 million out, that projection number is going to go up significantly. So when you write down the investment thesis in your mind of numbers, having $0 invested and receiving an infinite return over that number, $9,000, is a great return post risk, right? You have all your money out, you have all your return back, you're continuing to get returns. I hope I answered that question for everybody. I want to thank you all for being here this evening. We will share this webinar with people via the internet, via an email, and it will be uploaded for view. Once again, I want to thank my partners. I want to thank my team at F Street, and I want to thank you, the investor, for thinking about joining us this evening and spending an hour with me. Thank you so much for being here. And if you have any other further questions, please feel free to reach out to me. Have a wonderful evening.